let's look at the number one thing that's really keeping things pumped up right now is we had the biggest liquidity money pump in history. We still have the repercussions from that. And of course, the largest, what is it, 6% largest fiscal spending of GDP outside of a war.
And they haven't dispersed all the funds from those.
Yeah, that we still have this unstoppable force of massive fiscal spending, 6% of GDP. It's never happened outside of a war or a recession. And it's just, where's it stop? I don't know. Some point it's going to, but that's keeping the Fed partly restrictive because they know, here's the thing you and I both know. I've been a Fed watcher since 88 is for the concept of the Fed to ease in the middle of a significant speculative frenzy. I did the math a little while ago. You get that S&P 500 25% above its 100-week moving average. Fed doesn't ease in that environment. That's when they take the punch bowl away. They can't, though, because they help create this. We're at that unique spot. It's lose-lose. And you look what's happening is almost the rest of the world is cutting their rates because they're heading that way. The world's heading to a recession. First of all, let's look at the average. First, I'll start with this. The Fed funds rate in this country at 5.33% is about 3% above CPI. The average for last year is 1.5% below. So it started at 5.33% if interest rates matter. And then you look at the average of the next 5 countries in the world versus our 10-year notes, obviously inverted. So that used to matter, inverted curve. It will eventually. But the average of the next 5 countries, including India, is about 100 basis points below the U.S. 10-year note. China is 200 basis points below the U.S. 10-year note. So there's severe deflationary forces in the second largest country in the world, and they're trying to export it. That's not going to get better, I don't think. And of course, it's just this process of China is going the way of Japan. But so my point from inflation is people think it's enduring, they feel it, but we have not had a real stock bear market since the bottom in 2009, maybe a little bit in 2011, maybe a little bit in 2022. But every single time people know, oh, you dropped 25%, you got to buy more. That's going to change. At some point, we need to go down and stay down for an elongated underperformance period. It's always happening unless history has changed. And particularly it happens when you just get too expensive, like the 1987 crash. We weren't expensive. We just were for a short-term period. Here's one little statistic. I love pointing out things like there's so many little things there, but you just look at stock market cap to GDP before the 1980s and before 2008, around 2007, we were about 1.2. Now we're 2. So just very expensive. That's where that deflation is going to come from, just normal reversion. But then from a commodity standpoint, the number one measure of, I pointed out, heat, electricity, and fertilizer, natural gas is plunged. Why? Because we just create more of it for less every day. And then we just know that what's the fact that since the end of 2019, money supply in this country is up above 35%. That's never happened. Okay, so that's going away. So I think what's going to happen now, so let me predict the future, is the lessons of Jeff Booth, who taught us that humans are just about measures of error correction. We have learned the lessons of way too much liquidity inflation. What does inflation do? It hurts the little guy the most. It hits the average person. 55% of people in this country are wage earners. People like us who own stocks and have decent jobs and own property, it helps us. But we're learning that the vote is going for everything is against inflation. So next time the Fed is at the trigger finger to cut rates, there's going to be pushback forever, just similar we've seen in Germany since the Weimar Republic knows you can't cut rates because the last time you cut rates too much, you ruined it for everybody. You made it difficult for me to buy groceries. It might not be true so much, but to me, that's where we're going. And I just look at from a technology standpoint, it's unstoppable. If we keep that money supply somewhat stable, look at everything versus the price of gold. As you mentioned earlier about equities versus real assets, the best way I think to look at the stock market sometimes versus a real asset is just look at gold versus the S&P 500. The ratio right now is 0.43. The average since 1900 is 1.34. Okay, yes, there's disparity. The stock market got really expensive in 2000. So to me, it's just a matter of time we go back to that 1-to-1 ratio versus gold, which is part of the reason I'm still bullish gold.
Also, just a couple, versus the 2000 cycle in '08. In '08, we had a credit cycle that was involving speculation in the housing market, where banks were extending credit to buy homes. And that also was financed by the capital markets with subprime securitizations, created a bubble there. In the 2000 market, we had a tech bubble. Here, we don't have bank credit growth, right? It's flat year over year. The banks are on their heels, just trying to conserve liquidity and get by. They have these bank hold to maturity issues, and they're just trying to heal and just generate profits to get to the other side. We do have financial assets that are ripping, but at the same time, we have earnings growth as well. NVIDIA is not a Cisco. They've delivered on earnings growth. and the forward PE is around 21, which is on the higher side, but it's also consistent with earnings growth. We've seen multiple expansion, but at the same time, we're seeing companies, generate record profits. In 2000, that wasn't the case, right? We had PE ratios of 1,000. We don't have that right now. It seems like the market's got more disciplined. 2001, we had Cathie Wood's ARK hit record prices, and now it's not. It's actually in a bear market. So speculation has maybe shifted. Maybe it's in Tesla stock today. Maybe it's in a new, maybe it's in NVIDIA. I think that's very well possible. Is there not a fundamental earnings-led driver to the equity rally?
Well, we have to admit, we have to go back to where we started, is the government is spending 6% of its GDP every year in deficit. So that's part of it. I think the key thing to remember here is the lessons of Jeff Booth, The Price of Tomorrow, is BYD is doing to Tesla like Huawei is doing to Apple. It's just the technology is moving so fast. And yes, the profits are great, but we also have to remember what got us here is the biggest, longest period of zero interest rates in history and the biggest money pump, just throwing money at anybody in history. Compared to a credit crisis, government just writes checks to people. Yeah, assets are going to go up. We're going to get inflation, and assets have been going up, and there's still a lot of that money running around. So that to me is the party that still needs a little bit of reversion. So I'm not saying you should be short equities, but I think it's really a time it's been that way to look for alternatives. So for a while, that's been Bitcoin. Bitcoin is known as the fastest horse in the race. And lately, since that perfect storm for new highs in Q1, it's showing pretty significant. The leading indicator is lagging, showing divergent weakness. So I'm getting a lot of signals from my indications, from the macro indications, very low volatility, high interest rates, leading indicator lagging. Just the relative price of S&P 500 versus the MSCI ex-US index at the highest ever. So many of those things that say, yeah, there's just levels you're not supposed to be overweight long. And also, I just love how people justify the higher levels when, like, yeah, I remember hearing that in the past. And there's alternatives, like 5.3% in a T-bill.